Hey guys, today I want to talk about how you're being punked and played for a fool by a lot of financial analysts. Most of them probably don't realise they're doing it, to be fair, but some of them do, and in fact that's how they're keeping themselves in a job in some cases. Some of them have even built a good name for themselves based on what they're doing, and somehow they get to carry on doing it. You may have also seen some online traders trying to show how great they are by using the same techniques. So in today's video, I want to shine a light on some of these antics so you can stop being fooled by them and see them for what they really are. So this video draws on a few different concepts that we've discussed recently, which I'll try to point out as we go along. And I think it's really important that we have videos like this one, which help to connect the dots for you, because I really want you to start seeing how all the videos that we've put out recently are not just standalone videos about standalone topics, but they all actually come together as one interconnected subject, all the way from psychology to technical analysis and even monetary systems. So let's get stuck in. When I was a kid, I used to go through loads of different phases. One week I wanted to be a tennis player, then a footballer the next week, then a fighter pilot, then a boxer, then an architect, and at one point I even wanted to be a magician. I used to buy all the little tricks and subscribe to magazines that would arrive in the post, and they'd tell me how to do loads of new things. And one of these things was something called cold reading. And although I never attempted it at the time, it must have stayed in my head all of these years. But I never would have assumed that it would become such a key point in deciphering the bullshit from the truth in financial services. But somehow, cold reading is a big part of what is fed to private traders and investors as if it's absolutely fine. But it's not. So I went online and looking through a step-by-step guide to how to do cold reading, I came across the following points. So number one is be confident, which, it helps if you come from some sort of senior position, or at least you can pretend to be coming from a senior position. Number two is gain your subject's cooperation from the start. You can make them feel part of some sort of select crowd. Like, oh, you guys are great because you understand the truth. The rest of the people are idiots. Or you could even create a cult. Hey, that works as well. Number three, use stock phrases like cliched, ambiguous language that we see all the time. And number four, give the impression that you know more. Oh, what? You can see the order levels? Wow, you really must know what's happening. There's also a famous technique called Barnum statements, where you say things that would apply to anyone. So it's sort of like when they say in horoscopes, like you're on the verge of making a big decision in your life. So you can see how both ways, like whatever you're doing, you can kind of find a way that it fits into that. So now let's take an example from a financial analyst in the news. And I've picked this one at random, and I have nothing against FX Street. I actually think it's a really good website and I do use it myself every day. And I also have nothing against this analyst or this company. It's literally every analyst that does this really. But just to prove I've got nothing against them, I've censored their name and censored the company. So let's read it, and then afterwards I'll map out exactly what is being claimed on the chart and we can see what they're actually trying to say. So here it is. US dollar Japanese yen downside pressure could test 111. The pair stays within a neutral stance in the near term, while it could visit the 111 handle in the near term, according to FX strategist at beep, going to censor that company name. So expectations for US dollar to form a short-term base was wrong, as the break of the strong support at 112 resulted in a sharp drop to a low of 111.66. While the decline is overextended, it is too early to expect a significant recovery. US dollar is more likely to consolidate its loss and trade sideways at these lower levels, likely between 111.55 and 112.30. While we've held the view that US dollar is under pressure since earlier this week, the ease of which the strong support at 112 was breached comes as a surprise, overnight low of 111.66. Downward pressure has increased further, and a move towards the major support at 111 would not be surprising. At this stage, we view the US dollar decline from the 114.49 high seen earlier this month as a correction and do not expect a sustained move below 111. Resistance is at 112.5, but only a move back above 113 would indicate that the downward pressure has eased. Okay, now this might sound insightful, but if you look at the chart, they've actually just predicted that anything can happen. So let's go through it, okay? So expectation for US dollar to form a short-term base was wrong, as the break of the strong support at 112 resulted in a sharp drop to a low of 111.66. Okay, that's just them telling us what's happened already. While the decline is overextended, it is too early to expect a significant recovery. That's a bit of an open statement, it's not really telling us much. US dollar is more likely to consolidate its loss and trade sideways at these lower levels. Okay, so it's telling us it's going to trade sideways, not telling us how long for or anything, it's just going to consolidate. Likely between 111.55 and 112.30. So let's include those levels on the chart. So we've got 111.55, 111.55. So that's one level they're saying it's going to trade between. And the next one was 112.30. So again, 112.30. Oh, 112.30. There we go. So it's going to trade sideways between these levels. Now, the price is already in these levels when this article was printed, which is today. So really, even if it just stayed in these for just one day, they've left an open statement. They're saying it's going to trade sideways at these lower levels, but they haven't said for how long. So if it just stays in there for a couple of hours, then technically it's satisfied their statement. So since the price is already in those levels, from the moment they've written it, it's already going to be correct no matter what. Anyway, let's move on. So while we've held the view that US dollar is under pressure since earlier this week, the ease of which the strong support at 112 was breached comes as a surprise, overnight low of 111.66. Downward pressure has increased further, and a move towards the major support at 111 would not be surprising. Okay, so they've just basically said a move towards the major support at 111 would not be surprising. So in other words, it's possible in their minds. So let's add that to the chart. 111.00. There we go. So there's another level that if it goes to that level, then it's no surprise to them. At this stage, we view the US dollar decline from the 114.49 high seen earlier this month as a correction and do not expect a sustained move below 111. Now, what does a sustained move mean? It's all in the interpretation of whoever's reading it. Sustained for one person can mean something else to someone else. But resistance is at 112.5. So let's add that because they're basically saying there's a point there that's important, worth noting. So 112.5. There's resistance there. But only a move back above 113 would indicate that the downward pressure has eased. So let's add that one now as well. So we've got 113. Now I don't know about you, but first of all, they've got a box that's sort of spanning across this area here without saying how long those levels are important for. So it could be one day, could be a week. But in any case, while it's inside this box, their article is correct. So they've already hedged. Now second, they've pointed out a phrase at the end which a lot of people use, which is that resistance is at 112.5, but only a move back above 113 would indicate the downward pressure is eased. So basically they're saying if it goes above 113, then the downward pressure is eased. And if it hasn't, then it hasn't. If it doesn't break above that, it hasn't eased. So I don't know about you, but if the price goes from here to above here, I would also agree the downward pressure is eased because it's moved all the way up there. So it goes without saying. But these are the kind of articles that they get away with. So in addition to like all of the things we've pointed out, they've allowed themselves as well the chance to claim that they were right in any situation. As they haven't given any definitive date, they use terms like short term and a sustained move, but not saying what that actually means in terms of dates. As I said, one person's short term may be another person's long term. This is sort of like the video we did recently on cognitive dissonance. Like a key way of people overcoming this dissonance is to claim that they were right regardless of the outcome because they don't set a date. So it's like The Economist, remember? If the action in question doesn't take place, they can say, but it will at some point in the future. And if it does happen, they'll say, see, I told you it would happen. So regardless of what happens, they can claim that they were right. So it's like if I told you right now that it's going to rain wherever you are in a short term. Whenever it does eventually rain, you might choose to think I'm a genius or a psychic, or alternatively, you might see through my open statement and realise I didn't specify what was short term, so it was just a bit stupid. Now, any trader will have a plan for how they're going to trade something. So if they are going to give their analysis, they can at least explain precisely what they'll expect to happen in each situation. So for example, with our technical analysis videos that we do on Sundays, we aren't providing signals for opportunities and we don't get into predictions about what we think is going to happen. However, we do have very specific entry criteria in terms of needing to have a type 1 or a type 2 close on a significant level and using the triad of price action as a negative filter. So when we draw all the significant levels on the chart, you can essentially follow whether what we've analysed is correct or if it was just all bullshit because you have our entry criteria. You see, I didn't used to look at what other traders online were doing. I didn't care about it, I didn't need to, but since starting on YouTube, I see videos in our recommended tab. I've also been contacted by some of the biggest channels both in the UK and around the world for us to collaborate with them, so we've checked them out. And what I've seen is a lot of people trying to play on our human psychological quirk to find patterns in anything that we can. Literally, when we look at something on a chart, we're straight away looking for patterns. When we see something happening, we're looking for some consistent story, some narrative. It's just what we do. It's how we relate to things. So what they'll do is these so-called traders, they'll show something working on a chart and your attention is going to be drawn to that. You're going to see, oh, it worked perfectly when that happened, rather than the 10 times that it didn't work previously that they just brush over. But that's not even the worst. The worst are the people who are proving that they've done analysis or provide signals by taking what I call the spaghetti approach. So the spaghetti approach is a child-friendly version of another thing that you can throw at a wall to see if it sticks, but we're going to keep things PG here. So when I was at university over a decade ago, I lived with a few friends in my second year and one of them didn't know how to cook. The easiest thing was to teach them how to make pasta, since, it's straightforward. And with spaghetti in particular, someone told him that if you throw it at the wall and it sticks, then it's ready, it's cooked. So a week later, we had one wall in the kitchen that was covered in pieces of spaghetti. But you couldn't see the pieces that hadn't stuck against the wall and were now down the back of the cooker. Those were hidden away. Now, this was really bloody irritating because we had spaghetti stuck to the wall, but it's not nearly as irritating as when you see people taking the same approach in the financial world. Let me give you an example because I saw one very well-known so-called trading academy doing this recently on their website. I don't think they realised that they had all their old trade analysis pieces from TradeView up on their site for everyone to see, and I don't think people were even looking into it so deeply that they noticed them either. But basically what they'd done is analysed, let's say, 20 setups, and quite clearly they weren't trading any of them because they were absolutely ridiculous positions to take. But then you can press this little play button and see how the trade played out. I think it's a feature of TradeView or maybe some sort of alternative. But anyway, you can press play and in almost every single case, the trade failed miserably. In fact, it was so bad that you could almost say the market had done precisely the opposite of what they expected. They had these little arrows of what they expected the market to do and it did pretty much the opposite. Yet somehow, when you look on their social media, and there are screenshots of all these trades that played out, they're the few that actually worked. They don't show the ones that failed miserably, they just show these couple that really worked. They're proudly displaying their spaghetti stuck all over the kitchen wall, while the trades that failed were nicely hidden down the back of the cooker. But guys, pay attention to this, because analysing a trade on TradeView does not mean anything. You can do it in hindsight. With TradeView, you can actually put the trade in hindsight as if you actually took that trade, so it doesn't mean anything at all. If I put the little green box and the red box and say, hey, look at this trade that I closed today for all of this profit, doesn't mean anything. It's just another case of Mystic Meg style predictions. And it seems that people are either taking the financial analyst approach, which I can accept because at least they have a CFA in a lot of cases and are actually financial professionals, or they take the spaghetti approach like I just explained. Or sometimes they'll simply take the Barnum statement style approach, where they'll name two different levels on the chart, like with this box here, and claim that a strong breakout of that level will be a short one, this one down here, and a strong breakout of the level above will be a long one. Yes, but now try and trade it like that, punk. Now, what I'm basically pointing out is something I spoke about a little while ago. And by the way, if you look in the description box, there are links to a few videos that are related to what we're discussing here. So you can go and watch those after to get more detailed sort of breakdown of what I'm trying to say. But basically, I said that you can't predict the future entirely in trading. You can't just say the market's going to break up to 1.15 when it's at 1.1 now, just on a whim. Instead, you need facts and you need reasons. So for example, I can say that the market has a high probability to reverse if it's reached a significant level and there's clearly weakness in the trend. I can't tell you what price it will get to, but I can tell from the fact that it's at a significant level and previous momentum has been visibly running out that there is weakness in that trend continuing, and therefore a reversal is likely. But how can I predict those characteristics way in advance by, if we're at 1.1 now, saying that the market's going to reverse at 1.13? You should only look at the facts and use the facts to your advantage. You've got to try and be like Sherlock Holmes using the art of deduction rather than Mystic Meg trying to peer into a crystal ball. It's just like Philip Tetlock's study about experts in politics and economics. He tested them over a number of years and their predictive power and found out that, in fact, they were no better than ordinary people. And we spoke about it in a video about improving your calibration with your success rate. These people, especially if they're in the public eye, are either playing it safe, like what we just said with all of this ambiguous language, or preying on the fact that people are only noticing the bold predictions that they get right, rather than the bold predictions that they get wrong. This is like Jim Cramer, when he shouts his mouth all over TV, he makes these bold predictions, gets all of your attention all the time, and people notice the ones that go well. Oh wow, Jim Cramer said Apple stock's gonna go up, amazing. But luckily, there's a few of us out here that still remember his idiotic moments too. So anyway, I'll leave that there as I think it's good food for thought for you. I just wanted to make you aware of a few of these things, and I know it was a bit of a rant, but hey, some of you like those sometimes. So if you want to know more about our method of trading, you can sign up for our Inner Circle mailing list. So you can get access to our 4-part video mini-series to learn the foundations of our method. It's all free, no cost at all. The link's in the description box. If you like this video, please do give us a thumbs up, and I'd love it if you left a comment below just so I know I'm not talking to myself. And of course, feel free to subscribe for more videos about trading, economics, and the financial markets. Thanks a lot for watching, take care, and I'll see you soon.